That's why the pattern is so important. You really can't count the levels in there. It's a little harder. But the patterns and the timings are right there, exactly as I stated for you and illustrated and drew out. I mean, one could argue that this is the U.S. reversal, and this comes in around 9 o'clock in the morning, whatever, and then they go back in the consolidation. But this is the epitome of what I've drawn for you on the charts. It's there. What I want you to do as a trader is stop getting caught up in the moment. Getting caught up in the moment forces you to make irrational decisions. You need to have a plan of attack before you come to trading in line with the market maker's trend. Don't let the aggressive moves fool you. Don't let their big spike candles to the high lure you into thinking it's momentum. There's going to be a midweek reversal which will coincide with the intraday reversal and levels. Okay? What I meant was, okay, let's draw this little pattern over here, okay? Consolidation, Sunday, Monday, right? Sunday, false move. Let's just call it Sunday. They break to the downside. They hit a level. They pull back. This might be Monday. Okay? They have a trap amount of volume there. They go into consolidation. Tuesday, they come back and repeat the level. This is a multi-session W formation. But what happens here is they come back. This might have been Asian session. They come back and repeat the level at the London Open as a stop hunt. They disguise the second leg as a stop hunt to make the traders continue short. They take out anybody that went long in here, and then they reverse the market. Then you will have your 3-day unidirectional swing to the end of the week or going into Thursday, and then they will make the pullback to end the week and end the consolidation off of the high. This number in the 3-day range might exceed the net change allowed for the week. So they have to pull back to end the week below their net change allowance. The threshold might be right here at 500. They exceeded it. They know what they got to do. They got their marching orders. They got to come back below and close. Okay? Once you can identify consistently, and by the way, the 1-hour chart helps with this, the midweek reversals and the multi-session M's and W's, you can convert your spot trades to swing. You know you have 2.5 to 3 days of upcycle or down cycle with the maximum potential move of 200 to 600 pips. If you catch the trade going into Friday, understand that you're going to get a reversal pattern coming out of one of the opens, London or New York. You're going to get a stop hunt. If the stop hunt is counter to your directional bias, you take. All right, let me explain that again. If you get into day 3 and you're a buyer at the beginning of the cycle, when you get to day 3, if London Open, they come out and hit the stops high, you take. You get out because the reversal is coming. You react to their action. Market makers hit the stops low, you buy against the retail trading herd. Market makers hit the stops high, you sell against the retail trading herd. The M&W, the multi-session M&W will be very, very aggressive. Think about what they're doing. They're taking profit, cleaning the board, and putting money in their pocket. In order to do that, those levels have to be very aggressive. Okay, now let's look at some typical week stuff. Now that you understand a little bit more about the pattern. Okay? Aggressive move, week beginning. Trap the traders, jam them up. Stop hunt low, rise. Back into consolidation. Stop hunt low. Rise 100 pips. An extended high of the week formation. Extended. Why? The blue box is 103 pips. This is about a 150 pip move. What happened? You didn't believe me I wanted long? I'll show you long. But if you notice where they cut the level, this is in fact peak formation high for the week. If you have a peak formation high for the week, we expect 3 days of drop. Okay? So what's expected? I'm going to give you some more slides on this, but think for a minute. Day 1, peak formation high, high of the week, got it. The next night, hit the stops high drop or straight drop. The next night, hit the stops high drop or straight drop. 3 days. End of the cycle, look for the W reverse. That's the 3-day swing trade cycle. Peak formation high, high or low of the week is identified. You expect 2 more stop hunts in line with the peak formation. If he throws at you something different, exit the trade and look for a new signal. Okay? So here, peak formation high of the week, right? You got the midweek false move. They jam people up long. People think this is the famous continuation. When the high holds, notice the blue tracer in here. I'll talk about that. Very important. When the high holds for 30 to 90 minutes and they pull back, you have your peak formation. The projection is MAW. A1, A2. Peak formation, V-top turned over, V-top, reversal. Okay? 3 levels are seen. 1, consolidation. 2, consolidation. And 3 was underway. Okay? The 2 cycles, and I have slides for this, I'll talk about it again, is WVVM. It looks like a W. 1, 2, 3, reverse. 1, 2, 3, reverse. That's the market maker cycle right there. Okay? MAAW, WVVM. Why the V's? Sometimes you'll get W's every single time. But here's the thing. If you have your market maker bias high of the week, low of the week established, and you know the direction, you can trade off of the first stop hunt out of the box V bottoms. You don't have to wait for the second leg because you know the cycle. The best trades are multi-session M's and W's, multi-session or intra-session M's and W's. Those are the best patterns, beyond a shadow of a doubt. It allows you to grab close to the low of the day. Your stops will be tighter. It avoids you sitting through the repeat the level stress of them coming back. But if you understand the cycle and caught the directional bias, then this spot trade can be converted to a swing. Why? I caught the peak formation high. The next night, hit the stops high, I'm still good. If they break out of the top of the box, I'm still good in here. Why am I still good? Because they hit the stops high, issued railroad tracks at the London Open in line with the peak that lets me know it's a false move drop. Now, they've created some amount of margin trouble. They've created a ton of congestion, right? Chest colds in there. Hitting the stops in both directions, picking up the contracts. No congestion. Take some NyQuil. Or some Tylenol PM or something. You understand that you got one more day of drop on the cycle. Your bias is to the downside. So you're looking for excuses or reasons, stop hunt high drop. Okay? I don't want you to counter trend trade at A1 and V1. I don't want you to trade back towards the peak formation high because it's a sucker's trade. I have slides, don't worry. I'm just illustrating it now. We'll get to it. Okay, here it is again. Consolidation. Peak formation. I expect. Hit the stops high. Same slide. Sorry. Now the reversal comes in. End of the week. I expect this. I had 3 levels of drop. The pins on the candles will become the direction that they're trying to trap. Very important. Write that down. The pins on the candle at level 3 will become or start to paint in the direction that they are trying to now trap. Level 3 aggressive moves will be seen. Notice how the first 2 days of the cycle it drops down smooth, and then when you get to level 3 it doesn't seem to go anywhere. Why? You're reeling it in, reeling it in, reeling it in, grabbing up the traders. Okay? Again. Hit the low, spike it. See how this went slightly past it? They spiked it with a hammer right outside the box. The spike of the low absorbs the pending and triggers the stops of anybody that got it right. They open the spread at the low of the day. You'll see them work this. The spread gives them an edge against the retail traders. It's their weapon. If you're a buyer, they open the sell side, drop the sell side below the price point. The sell side picks up those orders for short holders. But the buy traders are held. The level is held. It doesn't move. It sits there. And the same is done in the opposite direction. At the top of the price range, the sell orders are held, and the spread is opened up to pick up any buy orders on the other side. They work the spread against you. They work the spread against you to pick up the orders. Okay? Some typical stuff that we all know. When traders lose money, they usually take a day off to reevaluate their decisions, their life, their family, why the hell they got in this crazy business. I've read every freaking book. How come I can't make any money? Market makers know that this is happening. They know who they've called out. They know who's in trouble. They know how much money they made. They go into a chop, which I showed you on that previous chart. It looks like it's level 3. We call it level 3 behavior. That chop gives you a chance to come back, reparticipate in the market. The levels don't change. They hold it. They're chopping, chopping, chopping. What happens? You go ride around in your car in the middle of the night pissed off, go to lunch, pet your dog because you've been kicking them all week. So they got to hold the market and chop it around to get traders back into the fray. The cycle continues. The behavior starts over, and they suck you in again. Okay, something very important. The patterns are the same no matter what time frame you're looking at. A multi-session M or W will look a little different on a 1-hour chart or a 4-hour chart. The 4-hour chart might be railroad tracks because it's 8 hours, 2 sessions, right? 4 hours a candle in, 4 hours out. On a railroad track, you might get, on a 1-hour chart, you might get one railroad track on one side and a spike on the other side of the leg. But understand that the W or the M, when it's formed, it will be very aggressive. But once the work is done, you will get a straight aggressive move away from it. That's where you've been blinked your eyes and been down big in a trade. Our group goes into profit immediately and stays in profit. It's absolutely amazing when you catch it right. You're going to see. When you grab second leg M or W, right after they issue the second or third spike, you're going to go right into profit. Some people are asking about the charts. 15 minutes, unless I say otherwise. The 1 hour and 15 minutes of what we're going to talk about in here. Okay, look. 1, 2, 3 bars to the low, aggressive. Shifter consolidation zone. Okay? Breakout traders had a bad day. The shorts got rewarded. The longs got punished, shorts got rewarded. Okay? Aggressive 3 candle move, pins to the bottom. Notice how the pins spike to the bottom and pull it away? They're snatching the market away from the lower level short holders and jamming them. They then quickly pull away and come right back. In here, in the U.S. session, they throw 2 pins to the downside at the appropriate times. Session changeover, Brinks trade. That move fails to take out the London low. This move takes hours to develop. You now have your weekly reversal. It came in late Monday. That's okay. It happens. They're not going to make it Wednesday at 3 o'clock in the morning, perfect for you every time. You got to identify what's going on here. You have the first hit to the low, late Monday, London session. The second hit to the low, U.S. session, 9:30 changeover, session change, second spike. End the session with a false move down, first spike. Start the session with a false move down. Hammer, issued at 9:30, equities open. Your trade is entered right there. You can't pick a better entry than that. Stop loss is tight, right below the low of the day, which happens to be the low of the week. You've identified this behavior. You can keep your trade, hold for 3 level rise. 1, 2, 3. Reverse is imminent at the mayonnaise. Pin to the mayonnaise is a sell. You take the reversal here, end the day back in consolidation. Okay? I don't want you to take that reversal as a newbie. That is mostly a jam move because they've snatched the market away so quickly on the second leg to put all the traders that are short in deep trouble. That aggressive move does not always give you a nice retracement to counter. Okay, that's the DNC. Do not counter V1 and A1. I got slides, relax. Mayonnaise is a 200 EMA. Okay. We have our directional buys for the week. We have a mini W inside an aggressive W after the false move down. 3 vector candles to the low. Fake out the traders, validate the short orders, show a trend continuation. What happened in here was you sell the rises in a downtrend. So what happened is the traders that were long ended up with a scratch +1 when they came back. The traders that thought they were right and had their stops all aggregated in here are now stopped out on the second leg. Any pending orders that were trying to catch the break below the low were validated or turned hot on a widening of the spread at the lowest point on the chart. Second leg, intraday U.S. session, intra-U.S. session rather. This hammer, when that hammer pulls back, that was solid red at one time, right? That went down there all the way down to the low of the day, came right near the low and sat there. When you start watching this shit, it's crazy. The candle will go solid red all the way down there and sit there. And you're like, the hell's wrong with that candle? Did it die? Did my computer feed stop? It's just sitting there at the bottom. The candle sits at the low of the day. Some dealers you can see this, some dealers you cannot. But if you put the bid and ask line on your live chart, you will watch those 2 lines separate. The separation of those 2 lines or the widening of the spread lets you know I got these bastards today. Because they're punishing the retail traders with pending orders that are sitting below those price points and stop orders that are sitting below those price points. The widening the spread is part of the confirmation process. If they widen the spread a few pips near the low, on the second or third pass to the low, you got it today. You own it. Validation comes in when they complete the candle at the end of the 15-minute cycle and issue a hammer at 9:45. That is the confirmed locked reversal. Confirmed by their behaviors at the appropriate timings. You got it. You enter on the open of the next candle. Stop loss goes below the low candle or the low of the day. You look at the big board. I'll talk about stops and we'll look at the big board and stuff. They immediately shift the market or shift the zone away from the lower level short sellers and in one candle take back all of this damage. See this square right here? This candle seems to take all that back in about 15 to 30 minutes. You know when they shift the zone and snatch the market away from those guys, game on. You got it today. That is the confirmation you need to know you're in the right directional move. They'll shift the zone in one big candle, 15 to 30 pips. They'll shift the zone in two candles, 15, 20 pips apiece. But the shifting of the zone comes in a 25 to 50 pip move to get the hell out of there. They want to get the hell out of there to put all the retail traders into a panic. And it works. You lift your stop, you get nervous, you're like, oh crap, what did I do? The shifting of the zone creates the fear and greed that you're afraid of in trading. So when they shift the zone and jam you, you go into profit trading this method, you know you got it. That is further confirmation that you have caught the right directional bias off of the low of the day. Think about what you got. Okay? Consolidation, 41 pip channel. Blue box. Okay, I'll circle what I'm talking about. There's the width of the box. Initial high to initial low is 41 pips. Market makers come out. They show 1, 2, 3 to the low. You guys weren't falling for it. They came back 1, 2, 3 to the low one more time. Vector. A big anomaly on the chart. A spike. Retail trader perceived momentum. The vector is retail trader perceived momentum. You take that breakdown. They immediately put the brakes on and issue 2 pins to the low. It's kind of funny. The pins turn to the downside. I don't see any pins on the other candles coming down. But now the pins are on the downside. They pick up the orders and snatch it away. Pick up the orders and snatch it away. Now they got you if you're a retailer. They quickly pull back. That pullback towards the 50 validates the, what the hell is it? Rally-based drop, I don't know, drop-based rally or some crap that they teach in these other schools. I can't remember how it goes. But anyway, but it's a two-pronged approach. It also triggers the stops on the second pass down of anybody that was long and got it right. And it also lets those traders that end up at a +1 or a scratch, makes you scratch out with +1 or +3 or -5. There's a lot going on in that aggressive W formation. Understand? Same thing in the M. Again, they flip the pins to the downside to trap the traders at the lower levels. Because after all, the 50 and the 200 are wide open. So you got anticipated continuation down. But we know now that if the low that was formed during London holds, and they make 2 more passes out at forming another W and issue a hammer at 9:45, it's game over. You are a buyer against the retail trend in line with the market maker. You own these bastards today. Further confirmation is seen on the shift of the zone off of the low to further trap the lower level short sellers and to take out the entire 6-8 hours of structure work all in here that they've done. That one candle destroys the entire structure that was built against the retail traders, trapping them all. The market is then into consolidation to create false sense of security for the downtrend continuation. It is again shifted away to trigger the stops, bounce off the 200 pins to the mayonnaise, and ends the day back in consolidation. Their business is done for the day. They did their damage. Okay? You guys good? Understand? Now, I have my bias. I know what to expect. The next night, I expect stop, hunt, low, rise. The next night, I expect stop, hunt, low, rise. They mess with you on the timings on this particular chart because they did the stop, hunt, low, and rise by the time you come to your terminal at London Open. It happened in Asia. You missed it. Not a big deal. But right at the end of the box, they threw railroad tracks to the low, and they even threw a hammer. There's a W in there, or there's a V bottom. You expect this, and they gave it to you. See it? Okay, they come out of the box, they go low. You are a buyer against the retail trader mentality long because you have your W formation. That's your anchor point for the week. W, V, V, M. Sorry about your luck. Do not counter. This is a counter here that worked. Do not counter here. I'm sorry, at V1. Do not counter at V1. It doesn't give you the trade. See the setup? It does not offer you the retracement to counter. It doesn't pay out. Now, notice how the pins flip to the top side. Notice how they flip to the downside over here. Notice how the aggressive moves end in pins to the top side. Railroad tracks at the U.S. session. This is level 3 behavior. Chop. 1, 2, 3 days of rise is seen. Disguised in different sessions, moved over a little bit to mess with your timing. Market makers give it out, give it out, give it out, need some back. Sell to the buyers, sell to the buyers, sell to the buyers. I need some of my money back, man. Correct the market. Okay, hope you guys are seeing this stuff. Okay, remember I mentioned in the thing, market makers will not move in one direction more than 3 days in a row without some type of collection of money. I know you say, Steve, the euro's been rising since my birthday, blah, whatever. I understand that. It didn't make a straight rise. Candles aren't stacked on top of each other straight up to heaven. They have to make pullbacks. Now remember the psychology element that's built in. The psychology element warrants that you will get on the trend at the worst possible time because of the 3 pushes inside the chart. They show you something, they get the whole world seeing it, technically, and then they act against it and mess with you. Notice the breakdown of this chart, okay? This is an entire week. Here's my Friday, Sunday, Monday tracers, right? Okay, let's look at it again now. Now with a different eye. Consolidation, false move week beginning, W formation, multi-session. I got a U.S. session, leg 1. I got an early Asian session, leg 2. Right? Intraday, spread out over the day tracer, right? This is the day changeover. This is the 5 p.m. reset settlement, these lines. Okay? Friday, Thursday, Wednesday, Tuesday, coming out of Monday's consolidation. Midweek reversal. Aggressive move towards the low, validates the crossover down. The W formation, late U.S., early Asia. You missed it. But guess what? They offer you a pullback in the U.S. There's your peak formation low for the week. 3 levels of rise, end on an aggressive railroad track, pull back, consolidate into Thursday, repeat the level, but murder the stops and pick up the pendings with a monster pin above the first leg. The light blue tracer, is yesterday's high and yesterday's low. When market makers throw a hammer above the blue tracer, that's for all the Joe Ross followers that take the breakout of yesterday's high. they snatch those guys and reel them right back in. No offense to Joe, he's a great guy. That is our signal. Notice it's in the red shadow box to enter. Three days, three levels. They hit it, they pull back. They go into consolidation. They issue a hammer above yesterday's HOD, or above, which happens to be the high of the week. Notice how the two come in together. The high of the day on Thursday coincides with the high of the week. They repeat the level on Friday, trap the traders coming off of the U.S. session into consolidation in here. Then what do? The pattern continues going into the weekend. Bam. They hold it and they spike down going into the weekend. Someone said the sound is bad. Is it? Give me some Y's up there if everyone can hear me. No? Okay. It's not bad, or no, it is? Yes? No? All right. Fine. Okay. Okay. Thanks. Got it. All right. So now, notice the difference in this W, how it's tight. There's only a few hours in between. This one is a whole day in between. This is London Open, re-hit again, almost in the U.S. session with a monster spike to the high. The monster spike to the high lets you know that they grabbed what they needed to grab. When you see that spike close, the damage is done to the retail traders. That spike is the aftermath or the wake of what they have done. What do they use to create the spike? Could be news, could be bullshit, could be your mother stubbed a toe. It doesn't matter. The behaviors are the same. They use the news to create that spike or create some type of anomaly on the chart to get you to fall for it. Listen, the retail side of the business works, or these guys wouldn't be so wealthy. Okay? Okay, so now you got trend is down, level 3 correction. You see this formation going into the U.S. session. They hold the level overnight. But you know the high was formed. They repeat the high. You're a seller against everybody else. You know that in level 3, the trend cannot go down forever and does not go down forever. You identify late in the U.S. session railroad tracks and then consolidation to end the day. You are a buyer against the retail traders' down move. And here's how it played out. This is what we call a half a Batman. They hit the stops one more time. If you weren't already in and you happen to be in front of your terminal, you're a buyer right there. I want to say 2 or 3 weeks ago, I think Rick's in here. There was a monster W formation in the Asian crosses. I missed it. I was eating at the Cheesecake Factory. That piece of cheesecake cost me thousands. It was double railroad tracks in the Asian session on GJ, EJ, and I think Rick just happened to be in front of the terminal and caught that 80 lots long. I don't know if that was okay to say, Rick, but sorry. And I think he booked a monster gain that day. So my cheesecake cost me, I don't even want to say the number out loud, it makes me sick. It was such an obvious trade that I promise you when you go back you'll see it. I want you to go back, write it down, go back to GJ and EJ, I want to say about 2 or 3 weeks ago. I think I was actually at the Columbia. I'm at the beach, so not now. I'm staying at the beach, but I think I missed that. I was at eating, I don't know, yellow rice and chicken or something. My gosh. Anyway, the moves are in there. Go back and try to identify that. Okay. I've been talking about their structures. Let's talk about the entire structure. Let me explain to you one more time. If you're sick of hearing it, I'm sorry. But this is, if I mentioned to you already, is the whole business. You got to get this. You got to understand. Okay? Every single day during initial market hours, Asian session, they're going to set the high and low. It's the initial high and low. They trade within that range and allow people to build positions, but not allowing anyone to take much of a profit. This is why you don't trade, Dave. Asia session. They then spread the swing. What time? 1 and 2 a.m. They widen the swing. That widening of the swing comes in before the London Open, because the Asian market maker wants to validate the pending orders for the breakout traders. Okay? At the start of the European session, anybody? 3:30? They will severely correct or rise against their real intentions. Stop hunt, false move against what they're really going to do for the day. The drop or rise will trigger all the stops of the weaker traders, the ones that have taken the school, the regular technicals, read the books, the stop losses that go 5 to 7 pips below your entry candle or above your entry candle. The weaker retail traders that have fallen into some proverb that says if you're going to lose, don't lose a lot and make a really tight stop. It's bullshit. They then quickly go into consolidation. They don't have a chest cold. The market doesn't have the flu. They are accumulating contracts at another level. They will hit the stops one more time, as I showed you on the previous chart. They threw the spike above to trigger the stops and pick up the pendings on the other leg, the second leg. This action leaves the lower level or higher level traders stunned and stopped out. And then in one bar, they will shift the zone and trap all the retail traders at the lower or higher levels. And that's it. All right, I'm going to back up. Someone said they wanted to write the chart. Actually, a lot of people said, I'm sorry. Let me leave this up. I'll shut up for a minute, and then we'll go back to the other one, okay? I just realized that what I should do is, why don't you mark down the stuff you want and then go back and listen to the recording and get it? Wouldn't that be better than holding me up? Because everyone's at a different pace. People are writing. I think that is better, right? I always remember it's about halfway through the first day. Yep, make a note that, hey, I want to see the section that was at 9:50 p.m. and then go back and move up to that timeline. Okay? Yeah. I think everyone's agreeing that I can just get through the slides and flow the recordings, and then you go back. Okay, sorry. All right. This is exactly what I'm talking about. You have the Asian range, right? R equals range, 51.4 pips. The ideal Asian range is 50 pips or less. The 50 pips or less allows you to see the stop hunts clearly. The stop hunts come in 25 to 50 pips below the box and above the box. Ah, now it makes sense what this is. Here's the 25 marker. Here's the 50 marker. The shadow box highlights the Brinks trade setups. Is it always going to fire in the Brinks trade box? No. But you have to have a deeper understanding of what's going on. Okay, so let's walk through this chart. You have consolidation, right? You have a pin to the low right here. Maybe they picked up some pendings. I don't know what happened here, but here's what goes on. Towards the end of the session, before the start, they shifted the zone away from higher level holders in here. But they stayed in consolidation. Do you see that? Your job is to be smarter than a piece of blue ribbon that paints on a chart. Your job is to reevaluate or reconsolidate the zone and realize they have not made a very aggressive move yet. When you reevaluate the consolidation, you then have your 3 vector pushes with a nice hammer to the low. Notice how they went past the blue tracer into the stop hunt zone. They even spiked through it. But they issued a hammer right here. Just outside. That was bad. Just outside the shadow box. Session beginning. The timings were off by a few bars. Big deal. You know better. They quickly pull back. Go into consolidation to collect positions. Validate the short orders. Okay? Now, notice something crazy. This candle comes all the way back to the low of the day, just enough to pick up anybody that was in here, anybody that got it in here, and that was right. Because of the size of this candle, this would be a pass entry for our group. Because they shifted the zone. If you didn't get your entry in here, when they shift the zone, it's too late. I don't want you chasing it. Why? Think about the size of your stop loss. The appropriate stop loss goes below the low of the day. But Steve, it runs perfect. Of course it did. You could see it in hindsight. Of course it did. But how do you know they're not going to come back for another pass? You don't know that. The stop loss goes where it goes. I can't help it. I'm going to talk about it. Jose doesn't know me. He asked where I got in. Jose, I got in right there, buddy. I know people are saying thought so. I'm kidding, man. I wish I was that good. All right, look. Because of the size of the shift of the zone, that's a note, that's a pass. But if you saw the hammer issue just outside the shadow box in the stop hunt region, you could have taken the trade anywhere in here. Stop loss goes below the low. That is a granny entry. Okay, now, the low should hold for 30 to 90 minutes. Then it's safe to enter. If you have all the other elements in line, they issue a hammer just outside the shadow in the stop hunt zone. It happens to be laying on the 4-hour timeline, which is the blueberry. We'll talk about it. They had their 3 vector candles on a reconsolidation of the zone. Right? You extended the blue box. You know better, man. That's consolidation. There's 3 vectors to the low, vector candles to the low. They ended on a hammer, pulled back. This is an outside bar. I don't care if it has a pin. I don't care where it closes. This bar is an outside. Man, I'm so close to the edge, I keep changing the slide. I'm very sorry. This slide right here, this is an outside bar. How could that be an outside bar? Because it forms the low of the day, and the consolidation is off of it. It's inside. The consolidation is inside the low of the day formation. That's an outside bar. Okay? When market makers trade inside this spike to the low bar, that's a clue for you that the low is forming. Because the spike here forms the low of the day. The consolidation validates that you are at the LOD. The fact that they spiked past the light blue tracer validates you're at the LOD. The fact that they spiked the 4-hour EMA validates you're at the low of the day. The fact that you're in the shadow box and they spiked past the shadow box and came back validates you're at the LOD. Those are the clues to the puzzle you got to put together. We like to wait for the second pass, but you got a lot of opportunity in here. This candle comes back to bust your chops a little bit, may or may not get you. Not a big deal. Don't worry about it. There'll be another setup just like it tomorrow, I promise, and that candle won't be so big. Okay? See it? All right. It's 10. Let's take a 5-minute break. We're going to go into the count, and we will end here tonight after this lesson. The count discusses the levels. All right, so let me get my little 7-minute stopwatch up. Someone asked where I got that from. It's like stopwatch.com or something. It's www.online-stopwatch.com. Okay, everybody back? Good? All right, hear me? All that stuff? All right, some of you are asking about the stuff on the charts. Robert, you're not the only one. Don't worry about that stuff right now. I'm going to break it all down for you. What I want to do is I want to strip away the concepts that you have about the market right now, and I want you to look at the big picture of what these guys are up to. Don't worry about a box, a shadow. I'm going to cover all that shit. It's on there. I know it's in my charts because that's the templates that I took the pictures off of. Just open your mind to what's going on. Okay? And I'm going to tell you what the box is, what the arrows are, what the average. I'm going to tell you all that stuff. Just right now, I want you to grasp the concept, okay? All right, so let's get going. I didn't see any questions other than that I need to address right now. We'll take some questions at the end when I give you your homework. Okay. The count. The third most important element of the system is the levels, or the count, to know where you are in the cycle. Right? You need to walk up to a chart and go, okay, midweek reversal, W's anchored in, second session, WVVM, Wednesday, Thursday, Friday, reverse. That's why you don't need to spend days and hours doing technical analysis. When you become proficient and can identify the midweek reversal or the peak formation anchor points of the cycle, you'll be quickly able to identify the technicals on the market maker side of the market, not on the where the average crossed over, what part of the cycle am I at, is that support and resistance from October 1905, will that hold? Understand? I said this in my presentation on the sales side of the business, that you don't got to spend hours and hours trying to analyze the technicals. You analyze a chart over 3 to 5 days, identify the anchor point, start of the cycle, and you know what to expect on every pair at any given time. Because the market makers have their own cycle and their own way of handling things. You now know how to handle that. Or you're getting there, or I'm getting you there. We'll figure it out, okay? All right. The cycle, as I said earlier, is based on trader psychology. Really, it's based on human psychology. Fear, greed, and inexperience are used to prey upon the traders. The newbies that don't know anything, fear that you're missing the move, greed that you're going to maximize your gain. Those are the emotions that everybody feels in this business. As I drew the pattern for you earlier, there are intraday counts and counts over several days, the weekly cycle. They are all there to trap the traders and grab your hard-earned equity. I've seen people write this a couple of times to me in chat. Oh, Elliott wave, blah, blah, blah. No. Do not associate this with Elliott wave or any other indicator. Market makers form zones or levels to trap the traders, book their profits, and hit the stops. Sometimes it's like a joke. You can see it like stairs. It's so easy. Sometimes it's not so easy. Understand that at level 1 and level 3, the aggressive moves are seen. Why? They just made a huge run. They snagged the traders. Some amount of money is stuck. They want to hit the stops in both directions, collect up the contracts, and then trap another fresh batch of traders the other way. The M and Ws form at these levels. Okay? There are 3 levels of correction or rise over 3 days. Could it be 2.5 days? Yes. There are also 3 levels intraday, the 3 bursts. If you know where you are in the cycle, it's easy to pick your directional bias and take your trades. The first level of the correction in this example is driven by the market maker. You will see the fast moves on light volume. You can't tell volume, by the way. You just know by the move. The guys that trade the breakouts with Craig and understand this stuff, think for a minute. Even if you haven't traded with Craig, just think for a minute. Open your mind for a second. Ever seen a candle spike really fast? In a textbook, that is written as momentum. But what's really going on is the market maker is flashing the pair with as little money as humanly possible to get it to move or spike. And other times you've seen the breakout slow and steady, a smooth run. The slow and steady move is the real directional move by the market maker. So the first level correction is created with a flash into a pair. He might do it on a cross, he might do it with the cross, whatever, to save money. I'll talk about that. The second level of the correction is market driven in absence of the market maker. Why? He wants to see where the retail traders will push it. So what happens is this. He creates a stop hunt high spike, pulls back, hits the second leg again, starts the direction, and steps aside. He wants to see what the traders will do going into level 2. Will they buy? Will they sell? How will they set the straddle? How will the contracts or the money be set up? The third level of the correction, when you get to level 3, is again picked up by the market maker. He puts the brakes on, says that's far enough today. He'll trigger the stops again, make the push, validate the ABCD lightning bolt, and create more panic in the market. So understand level 1 and level 3, since they are driven by the market maker, will be more aggressive. Those are the moves that have been scaring you out of good trades because you didn't understand that he was doing it to you. During the levels, market makers will buy from the traders to create their positions, with the heaviest volume being seen at level 3. At level 3, they're all in. They got to reverse and collect their equity back. Understand? When the signal appears, simply buy or sell third level rises and third level corrections against the retail traders. Lights out. If you can count to 3, profit will be realized in these trades. It's a joke oversimplification. Okay? Is there sound issues? No? Okay, cool. Okay, now, this is going to piss you off. It should. In addition to each of the 3 levels, there is a corresponding level of consolidation. Level 1 consolidation. Level 2 consolidation. Most of the time, when this is going on, the stops are triggered in both directions before the next level is started. The zones create 20 to 30 pip swings, be visible on the chart. Market makers are trying to hit the stops both ways to make easy work of the next level. They're trying to take the buying or selling pressure off from the market. So they slap it both ways. That is where, if you guys ever seen those little, they call them pennants. I hate that terminology because I don't like any of that stuff. It's garbage. But look, you have the move, right? They go down, they consolidate. Then what happens is it creates like a little wedge right in there, right? Then they break for the next level. Then they go like this. Forms another wedge. Right? Then they do it again. Now you're going to notice the pins start to the downside. Then they'll reverse. 1, 2, 3. Sorry about your luck. Okay, let me clean the chart back up. Okay. So now write this down and think for a minute. Market maker jumps in, 3:30, 4 o'clock in the morning, 3:30, 3:45 ideal, right? He jumps in. He creates the move, starts to panic. He shows you breakout vector candles the wrong way. He's showing you something, get the retail guys to bite. Retail guys bite the wrong way, he's got them. He pulls back quickly off of the high. He goes at it again one more time to validate, hit the stops. He then shifts away from that, 25 to 50 pips in the first level, and goes into consolidation. He then swings both ways. He may come back towards the high of the day. That move, coming out of level 1 consolidation back towards the high or back towards the low, scares you out of a good trade. Scaring you out of a good trade is his job, to make sure you don't actually make any money when you're right. Each zone of consolidation creates a little tiny wedge, if you will, on the chart. The pins are issued in both directions, and then the next level drop or rise is seen. He stands aside during that cycle, cycle 2, level 2 forming, sees how the orders are set, and then he says, okay, that's enough, and he reels it back in. He then switches the pins against the move. So if the cycle is down, the pins will start going to the downside at level 3. You'll see the spike candles, more aggressive moves will be seen towards the downside. If price is rising and level 3 is shown, the spikes will turn to the top side. Why? He's trying to trap the traders before he reverses. Okay? Think. All right, let's have a look. Get my little pen. This is classified, by the way. I can show it to you, but then I have to kill you at the end of the seminar. All right, look. 3 hits to the high. Didn't just this exactly just happen. This slide's like 2 years old, man. Remember I told you we pulled the curtain out from behind Oz. It's the same shit every single day, day in and day out. 3 hits to the high, stop hunt at London Open, hammer at 345 and 945. That's all they got. It's the same move over and over. Once you can identify it, you own them. Okay? So now, market maker starts the stop hunt, creates the panic. You reevaluate your consolidation zone. He goes vector to the high on you. He doesn't take out the previous high. Second leg M. Bam. Peak formation is formed. You enter somewhere in here. You got about an hour to decide. Level 1 correction. Pins down. Pins up. I see what you mean about the color. Let me change it. Let me find something pretty like a yellow. Okay. Wow, it erased it. Sorry. I don't know if that's any better. Correction, right? We enter in here. Pins up, pins down, forms kind of a little pullback wedge, right? Level 2 of the correction is smaller and weaker. But again, market makers hit the pins on both sides before the next level is commenced. Now something kind of funny happens. He goes into level 3 correction. He's got vector to the low in here. 3 pushes down to finish out the level, right? Funny how I only see pins on the bottom now. Here, and here, and here. Those candles were all the way down at one time. He's working the low. Now we know we've had on average a 50 pip drop per level. So we're at ADR, 150 pips. At 150 pips ADR, he starts issuing a pin at the bottom of the candle. The pin is a wick on the candle, whoever's asking. He starts issuing pins at the bottom. Do you notice that there's no pins on the top of these candles? Not necessary. I'm trying to trap short holders. So I push the market down, bam, snatch it away, gotcha. I hang around for 45 minutes, push the market down, bam, gotcha. Hang around for an hour, push the market down, bam, gotcha. The third confirmation doesn't happen very often, but I like this chart because there was 3 confirmations here, and then 3 mini confirmations. I can't draw it down there. It'll change the slide. Sorry. And 3 mini confirmations. 1, 2, 3. Do you see how 3 plays into the psychology almost always on these charts? 3 hits to the high, 3 levels of drop, vector 3. 3 pushes to the low, 3 pushes to the high, 3 pins to the low. In the retail world, that gets you to chase the wrong setups. In our world, it gets you to identify his behavior and beat him. Understand that this happens all the time in the market, in every market. You just have to identify it in real time, and the journey starts tonight. Okay, pretty cool stuff. I'm a little excited. I don't know. I really like this stuff. Okay, I can't change the slide. It jammed. There we go. All right, now, here you are again. Variation on the theme. Time. Consolidation. 1, 2, 3 to the high to end the session. Vector. Happen to have a little news in here. Market makers hit the stops in both directions with a spike. That trade's still good. How do I know? The high was not taken out. The high happened to hold. You have your peak formation high. You have your high of the day, U.S. session, and you also have your peak formation high of the week. What do I expect tomorrow? I expect stop, hunt, rise, drop. Why? Because I got the cycle now. I nailed it. It's anchored. Okay? Notice something kind of crazy in here too. There's 3 vectors in here on the downside. And then notice something else in here. There's 3 little baby vectors in there. And then they come back in the second leg. Form the W out and reverse. This is not a very good counter, remember? Okay, consolidation. Stop, hunt, high. This one happens to be, I'm going to write this initials down. You're going to say, what the hell? That's a stop, hunt, high, hold the mayo. It's not a sandwich. It's a trade. Stop, hunt, high, hold the mayo is simply market makers came out of the box, out of the consolidation. They used the 200 moving average as the trigger, which offered resistance at the perfect timing at the stop hunt. You know that this trade is a drop. How do you know? Because you already got your high of the week, high of the day, peak formation. Stop, hunt, high, hold the mayo. The stop, hunt trigger bars are held in place by the mayonnaise. This is also 2 pins to the mayonnaise. Okay? You have your drop. This is an example of where you have 1 level of move, and then you have 2 and 3 the next day. Then what do you have? Just outside the red box, they issue a hammer to trigger the stops of the continued, or the people that got it right long. Second leg, right? They come in, session changeover. They need to hit it 1 more time to get the stops. That's your entry. Back in the consolidation, end the day. They end the day always how they start the day. Okay? Away from the traders that are jammed up down here, they want to stick them. Okay? Okay, good stuff. All right. The peak formation started at the end of the week on Friday in this example. Stop, hunt, high, sell. They push down. See the low? That blue tracer lets me know that yesterday the price came in like this. When they go back to that, I got it. Second leg, same level, failed to break. Second leg, same level, failed to break. That's a big, fat W staring at you. That's good for about, I don't know, 400 or 500 pips, 300 pips. The retracement's 140. That's a 300 pip move. Continuation from Friday. Notice how they caught the retailers with the gap right there. We don't fall for that crap. We don't care. We got peak formation low. PFL. Peak formation low. That looks like an E, sorry. Here, let me see if I can do that. Peak formation low. Sunday going into Monday. There's your gap. Readjust your consolidation for the breakout guys. Readjust your market maker spread. There's your initial HOD. Initial low in here. Readjust because they gapped and shifted away. They gapped and shifted away. They don't want anybody to have a profit. They got them stuck. Now they come back. London Open. W formation. Second leg happens to be railroad track. Straight rise. Do not hold over the weekend. I'm not telling you to hold over the weekend. I'm showing you how to analyze the chart going into Monday. I see peak formation Friday. I know where I'm at. Now coming out, I expect straightaway. Why straightaway? They have to aggressively get the hell out of here because they jammed all these traders. Right? They got to get the hell out of that range because they want to stop everybody out and get them into margin trouble because they know who's in trouble. They have their list from the plugins. They got $100 million in margin trouble. If I clean that out, I'll put that in my pocket. I'm a market maker. So that's where the aggressive break trade comes. This also, by the way, happens to be the day that breakout traders make money. Second day of the cycle. Okay? In consolidation, what do you expect one more night? Okay, what's the cycle? W, V1, V2, M. That's the cycle, right? Anchor point, peak formation low. Day 2, day 3, reverse. Here you go. Day 1, rise. Consolidate, back into consolidation. Stop hunt low, rise. All of a sudden, man, the pins turn to the top side. Three levels of rise built into there. They come back just outside the U.S. Open. Issue railroad tracks. Retrace 140 pips, in case you were bored. They don't have unlimited equity. They must grab it back at some point in the cycle. Now, we'll talk about the continuation, but they can make a W and continue on the uptrend over here. They book a profit, get back into direction. Why? They have longer-term goals that they have to be cognizant of. If you think about this, if they went 3 days up, 3 days down, the market would never go anywhere. It would sit there sideways, right? And surely you'd figure it out. I know Craig would because he almost figured this out. Now, if you notice that trade, 150 pip retracement, 2 pins to the mayonnaise. If they put the second leg in at the mayonnaise, there's your stop hunt low, hold the mayo at the U.S. session in the red box. There's your retracement trade. These things repeat over and over and over again, and you're going to see them in the charts. And once you see them, you can't unsee them. They're in there. Okay? Good stuff. Hang in there. I know you guys are getting tired. A few more minutes, 10:30-ish. I don't want to beat you up too long. Okay. Now, here's the thing that's going to piss you off. This pisses me off. You know your support and resistance bullshit stuff you've been drawing on the chart? It's a hoax. It's a hoax. The consolidation zones created during these moves intraday create false support and resistance level that the market maker puts that's visible on the chart. Understand what I just said. The consolidation zones that he makes on the chart creates false support and resistance because he knows all the retail traders draw the lines on this shit. So right now, here's the pattern, right? Think for a minute. I drew this for you. I showed you this. I push down. I show you this. I push down. I show you this. Right? This crap right here ensures that some retail guy is going to draw a line through it and say that's support from February or August 2nd, 2011, and that should hold sometime in the future. He creates those zones to make you draw the lines. Hey, Joe, nice to see you. I'll get to you. I miss your coffee, buddy. Thanks for the nice email yesterday, by the way, to us and Compass. Okay, now, to sum this up a little bit. Level 1 and Level 3 aggressive moves will be seen. Market makers must book a profit and do so at Level 1 and 3. Level 1 can be previous Level 3. 3 levels of rise, they go into stop hunt, hit stops high, drop. That's your Level 1, your new peak formation. Level 3 becomes the reversal and starts Level 1. I know it's confusing, but think for a minute. If I have a trade that goes down 3 levels, 1, 2, 3, hit the stops one more time and rise, this becomes the new direction, right? Level 3 has now become Level 1, 2, and 3. Understand? If they're going to continue the reversal, or they're going to continue the uptrend after they make the retracement, this becomes the reset and you start the count over. We'll talk about this stuff. I just want to expose you to it. Okay? Let me flick the chart and get rid of my drawing and come back. Okay, so now, something kind of interesting. The head and shoulders pattern develops in Level 3 most often. Think about what the head and shoulders pattern is. Hit the high, pull back. Hit the stops, pull back. Hit the stops one more time. Sorry about your luck. Just kidding. Shoulder, head, shoulder. The difference is between us and everybody else in the retail world, they want you to take that pattern at the neckline. It's over at the neckline. I want you to learn to grab it here or here. Okay? I'm going to talk about it more, don't worry. Here's what I mean. 3 levels of drop going into the next day. Right? Here's the M formation. Nice drop. Consolidation. False support and resistance on the chart. False support and resistance on the chart. This lines up with some crap you'll project down here when you feel good. They come in, spike the low, Asian session, shoulder. They pull back aggressively. They come in, spike past the low to pick up the pendings. Breakout guys, snatch the market away from you. Hit the stops of anybody that was correct in this aggregate. Anybody that didn't move to break even, anybody that went to break even gets scratched out on the second pass. Either one of these is an acceptable shoulder, here or here, okay? Railroad tracks going into the session. But isn't the head and shoulder pattern, let me toggle this. Isn't the head and shoulder pattern a variation on a W? Ends on an M? Think. Forget about it. Amputate this guy's shoulder. We don't need it. Get rid of it. There's your spike to the low. Second pass, W formation. Take. You're in right here. Bam. The third try coming back doesn't take out either one of these levels. Trade is still good. Okay? So, this behavior exhibits Level 3. Do not enter the trade after the dang neckline's broken. You're missing the whole thing. The move is in here or in here. Okay? Again, there you go. Level 3 behavior. Why? Because what they do is they're showing you a downtrend, right? Averages are separated. The 50's past the 200. Water is below the mayonnaise. The 50 EMA is trading below the jar of mayonnaise, the mayonnaise, white, okay? Now, that's a retail trader's downtrend. What do you do as a retail trader? Buy the rallies. I'm sorry, sell the rallies in the downtrend. Sell here, sell here, right? But what's really happened is they've made the aggressive move towards level 3, issued a hammer, formed the low, come back, spike to that low, but don't take it out. There's your proper entry on the head and shoulders. And there's your straight run up. Do not go against the market maker setup. Trade in line with him. Okay, you can trade both ways on level 3, but that's more advanced. I'll talk about it later. I want you just to get the basic concepts right now. The bias should be changed from a downtrend after 3 levels of drop. Head and shoulders is seen. But look, just think about what this is. Draw this box right here. Took it out for you to see it. Okay, hold on, let me start over. Draw the box right here, okay? At the session open, they pick up the breakout guys, spike them out long, spike them low short, break plus a close, you enter here short. Gotcha, just kidding. Our group enters here. Okay? And in 3 bars, you're up big. Because this is usually a 50 pip channel. 50 pip Tokyo channel, right? They already, 1 bar is shifted off the low, 50. This next bar is about 50 right here. Then they chop around a little bit, hit it again. 50. There's your ADR. You understand? Okay. Never trade against the peak formation out of level 1 consolidation. That's the day the breakout traders are rewarded. The straightaway develops here most often. Market makers have gotten what they need at the head and shoulders, the aggressive moves, and the traders are jammed going into tomorrow. Trapped. They will not come back to the level because if they do, it releases all that money back into their accounts of the traders. Understand? By repeating back towards the level, they allow the traders to click out at +1, +5, -2, -3. They're not in the business of letting people out. They're in the business of jamming people. So understanding that keeps you in the right directional bias. WVVM, MAAW. Okay, my throat's starting to hurt. Don't confuse the 3 swipes at the stop loss, the vector 3 candles. Don't confuse the 3 pushes or pulses to the stop loss levels with the 3 levels of rise or correction. Some people are like, I don't understand. The 3 levels of, or 3 swipes at the stops are like this. They're tight and they're bursts. I'm going to cover that tomorrow. But then you have the 3 levels of move of approximately 50 pips each, depending on the pair. Australians like 35 pips each. Okay? Whitney, you know this stuff. I don't understand what you're asking me. Okay, now, we're going to end on this next couple of slides. Once you understand how the market is structured, there's only 4 trades that you should be looking for. These trades are 90% accurate and will not fail. I know publicly I can't say that because people think I'm absolutely insane. But I promise you, when you delve into the forum and start looking around at the family, you're going to see Carr, Kim, Granny, Scott, Alan Black, Rick. Their numbers are sick. Dave McCoy now, Zen and Diane. 7 out of 8 for the week, 5 out of 5, 4 out of 5 for the week with a net profit of 10 grand. These numbers are unheard of in this business because people are following the basic retail technicals and they're scared when I say that shit. They think I'm crazy. Well, I'm not crazy. I revealed it today. Okay, so now, mastering the handful of setups that I'm going to teach you in here will ensure your success rate. Tommy just posted he was 87.5% for his first week. Fantastic. These setups are going to ensure your success and produce returns and win rates that are unprecedented in this crazy business. I promise you that. Okay, here's the trades. Stop hunt high M formation, stop hunt low W formation, straightaway rise, straightaway drop. The cycle. That's it. Too simple, right? You need some like dots on there and shit. You need some BBs, MACDs. What the hell? It's too easy. If you take all the crap off your chart that I put on there for you, by the way, and just look at the price action, what they're doing, you're going to start to see the drawings that I've drawn for you. I talk about that stupid picture that was out. I don't know. I think I was in my 20s. It was a long time ago. You know, there was like flying saucers and dinosaurs and there's a bunch of dots. And you stare at it and you can't see shit. You're like, what the hell's that stupid dot painting somebody made? Something happens after you blink looking at it for a few minutes. You blink and all of a sudden the picture opens up and you can see flying saucers, dinosaurs, orange cows, green stars, blue clovers. I don't know what the hell's in those pictures. I never could do that, by the way. That's how I want you to look at a chart now. I want you to look at a chart with a different eye, a different set of beliefs and understandings. And I want you to blink, and all of a sudden you see the M's, the W's, the flying saucer market makers, the dinosaurs eating your stops. Understand? When you look at it with what I'm showing you, and it clicks, it's game over for you in your trading business. You own it. I don't know how long it's going to take you to look inside the 3D art and for it to change. Everyone's different. I still can't see 3D art. I don't want that to happen to you. I want you to be the starfish that I threw back. I want you to be the person that gets this and has success in your life. You all deserve it. Okay, it's 10:43. I'm going to end here. It's a good spot. I'm sorry if you're tired. I went a little longer than I like to go. I usually try to break around 10:30. Homework for tomorrow, my friends. You didn't want to hear it, but here it is. I want you to go back, and I want you to mark the charts. I want you to do Euro USD and GBP USD. And I want you to write on the chart everything I taught you today. You new guys do it. Old guys don't do it because I'm going to be slammed. I will look at all the emails tonight or tomorrow before class. Let me get a little white piece of paper over here. Let's see. Let's see. White screen, white. Okay. Here we go. I need my pen. Euro USD. GBP USD. Go back as far as you want. I don't care. Go back a month, go back 2 months, whatever. Okay, now, I want you to label everything that I talked about on the chart. I don't know if I spell that right. All right, let me review for you because you're probably like, what the hell did you talk about? I'm confused. All right, I want you to label. I'm going to make a little list. Vector candles, 3 swipes at the high or low, W's, M's, 3 levels of rise, 3 levels of fall. I want you to label end the day and consolidation. I basically want you to find this on every chart that you can. 1, 2, 3 to the high, pull back, hit it again, 1, 2, 3, W, reverse, end the day. I want you to label this. I want you to note the pins, the timings, the hammers, orange hearts, blue stars. I want you to label everything I talked about for the last 4 hours. Okay? Remember my email address? It's in the beginning of the slide, steve@mmmforex.com. I'm going to go through as many as I can. It's going to be a lot, but I'm going to get through them. I always do, I promise. And I'm going to take two or three of the outstanding ones, and I'm going to post them tomorrow for our review. We'll talk about it at the opening of the session. Okay? Any questions pertaining to today's information and homework that I can help with right now? Zen and Kim have been answering and typing in there, helping out with the questions. That's fine. Nice to see you, Lou. Can I type my email address? I can't type it because it won't type on the screen, but I can try to write it. Let's see. It's my name, Steve. Wait, let me toggle this and clean it up. Start over. All right, shit, it won't toggle. All right. STEV. See, you should have wrote that down. I told you to take notes. Steve at MMM4X. FOREX.com. I have another email address coming. I'm just too lazy to set it up on my Outlook. Sorry. Take a snapshot. Use Jing. Use screen capture tool. Lou, don't do it, man. Don't send me any charge, buddy. Okay, look. All the new guys only. Take a screenshot of your chart. Mark it up. Use Paint. Take a screenshot of the chart. Use Paint. Mark it up. Vector candles. Breakouts of the box. Stop hunt low. Hey, Lauren. How you doing? Stop hunt low. Stop hunt high. 3-level drop. Reverse pins. Mini consolidation zones within the range. Within the end of each drop. All the stuff I just talked about. I want to see if you learned anything or you sat here like a vegetable for 4 hours. 5 hours, sorry. Okay? Kelly, thank you. Lou, thanks. You're a ball buster. 15-minute chart. Yes, Whitney. Everett, thank you. Thank you, Veda. I'm glad you're here. Ed, thanks. Nice to see you, buddy. Thanks, David. Nice swing trading there, buddy. I've seen him in the forum. Great. Thank you, guys. This is good stuff, man. I love teaching it as much as I hope you love learning it. It's awesome. Peter, how you doing? Bruno. Tony T from Florida. Hope you're doing okay. Subio, nice to see you, buddy. Quit smoking, man. I'm going to quit Diet Coke. You quit smoking. Joe, nice to see you, buddy. I'm out of chocolate and I'm running low on coffee. Thanks, guys. Thank you, John. Thanks, everybody. All right, listen, I'm going to end it here. Have a great night. I'll rest my voice. I promise I'll be just as jacked up tomorrow. Leah, nice to see you. Alan. I'll see everybody tomorrow. Listen. Get some rest. Don't trade live money unless you're a Subio. He's the only one allowed. Seriously, new guys, don't trade live money. If you're up and you want to look at the market, open a chart, take all the shit off of there, and just watch them work. Open your mind and watch them work. Don't put any money on the line because it'll mess up your mentality. Just watch them work. Okay? I know you guys are going to do it. You don't listen. So anyway, good night. Good night, good night, good night. Kim, nice to see you. Thank you. Okay, good night.